What's up, guys? Welcome back to a new video, and today I want to go over a mechanical trading setup I took in the dollar yen that was very successful, and I basically want to dive into the trade, tell you a bit about it, why I took it, some confluence factors, and show you again the power of mechanical trading. So let's get started. All right, so we are at the dollar yen chart, and I first want to draw your attention to this piece of price action back in the day. As you can see, two highs forming, two high swing points. Price breaks it and then quickly falls down. And if you have been watching me for a while, you know I trade the daily time frame and the hourly. I trade mechanical, but I do add confluences around important areas, such as this area of liquidity. So my knowledge is that if one side of a range gets a false breakout, it tends to move to the other side of the range because that's where liquidity is. And so I expected after this move price to fall down to take out this low, which it didn't. It basically retested this area of structure over here and then started to range for weeks. Now, what's interesting is that it did break the highs, but never broke the range lows. As you can see, unbroken low, and it kept making higher lows. Now, to most people, this would be an uptrend, high lows, I'm going to buy. But to me, this just generates a shitload of liquidity below these lows. And I generally want to see what happens once liquidity gets triggered. Also, this important point here that create this up move that became my target for this trade. But if we go to this particular day, it took out the high of the range, then price fell down to the low of the range, then retraced, and then basically I got short at this area to target this swing low. I had my mechanical setup here, which happened in this area. Again, not going to give you my mechanical rules, but according to my back testing that I've done on this particular pair, take a look, went back all the way to 2006, got 187 trades, and it shows me a 66.67% chance. Price tagging that low green line before taking out my stop, which I will be showing you right now. So if we dive to the hourly time frame, so what's important about this time frame is that I had my mechanical setup and I had a bearish bias because of this swing low. That's important to the market, and this fake out at the highs. I was expecting price to take the low end of the range. Basically the same thing as I expected here. High breakout of the high of the range and then a move to the downside. And that's what I was expecting here. So if we go to the hourly time frame and take a look at what actually happened. So first of all, stop placement. I'm going to put in some lines here. I'm going to put in my entry. Around that area was my short entry. So we got that daily bias to go short. We got these statistics in my favor, mechanical trading setup. And basically here we have a distribution range, Wyckoff. It isn't that clear, but it is for me a distribution range. And if we look, price retested. So this was the high, the fake out of the high of the range. Price had some structure, fell down, never retested the origin. Price came back to retest the origin, and anyone that went short in this area probably placed a stop above there. Price then just takes out the high and then breaks the structure of the distribution range. It is at that point that it's a confirmed short for me. I entered short at the red line simply because that's my rules. This was the last significant structure to me, and we did close below that, although we did get a rejection. Doesn't matter. I use mechanical rules and I had to be short there. So I shorted there with a stop above here. That might seem like a lot of room, but because this move is without a retest, just like here, markets tend to go up and then fall down, just like we had here. And I don't want to be out if price does this, because then my trade idea is still valid. And that's something you need to think about for yourself. You really need to know when your trade idea is still valid and when it's not. I know that if price goes up here and retests, for example, its structure and then falls down, my trade idea is still valid. So I don't want my stop loss to be in that area. Now, people ask me, why don't you just short up there? Because I've been trading this strategy for so long, I know that the market tends to continue in the direction that I pick as soon as I enter. Sometimes it retraces a bit, but in terms of in terms of performance, I'm better off just entering at a breakout instead of waiting for a retest. But it's up to you how you want to trade, how you want to test. This is my mechanical strategy. This is my rules. So I entered there, targeted the lower green line. 2 reasons. First of all, my statistics. And second of all, well, my statistics showed me to aim for this one, for this target, but look at these 2 equal lows, and that's just that important swing point on the daily time frame. So I started off trading this mechanically using mechanical targets, but I've been trading it for a while now, and I noticed that if there is an area of liquidity, for example, with the short below my target, price tends to go there. So that's the area I tend to target. In this case, it's a 1.2R, so I'm risking 1 to make 1.2. And the win rate or the odds of making it is 66.67%. So as you see, there's a higher chance of me winning this trade. And if I win, I make more than I lose in the long run. And that's what it's all about. That is what trading is all about. So this is a positive expectancy. If I keep trading the same like I did in this area, I'm going to make money in the long run. So to give you a bit of a recap, I had a daily bias to go short. And before people tell me this is discretionary, yes. However, these statistics showed me already, if I only traded my mechanical setup, I had an edge. Plain and simple. If I only took the trade based on these mechanical rules that I'm not going to show you, I had an edge and I would still be profitable in the long run. But because I've been trading for so long, I do add a bit of discretion, such as moving my target a bit lower because of liquidity, and such as risking more if everything lines up from a liquidity / higher time frame perspective, which it did in that case because of this false breakout of the highs, because of this distribution range. So yes, I risked a bit more on this setup and it made me a bit more money than usual. And I had a bit of a bigger target. So that's where experience comes in. And mechanical trading is, in my opinion, the best approach for most people to begin with. But as soon as you've been trading the strategy for a while, and I don't mean a few weeks, but a few years, then you notice certain things, and then you can add some discretion, but it comes from experience. So don't just be a discretionary trader from the get-go. Yes, it can. Yes, it might fit your personality, but from my experience, beginning traders need a lot of structure. And the clients that I help with my coaching generally have not enough structure, and that's where their mistakes come from. They don't really know what they need to do once they're in a trade. They don't really know what they're looking for and when they need to enter. And if you are aggressive with placing structure in the beginning, then you become basically develops a habit of following a plan. And then when you have established edge with your mechanical rules, then after some time, you can look, all right, what are the connections between my winning trades? Are there certain things that line up and that usually allow me to make more money from a trade? That's what I did. I noticed that if my mechanical setup happens at a certain location or in a distribution range, the odds of winning increase by 10 to 20%. So I'm going to risk more on those. I noticed that if there's a liquidity pool just below my target or above, if I'm buying, so let's say I bought here, my target would be this area based on stats, but this is the liquidity pool. I would target that area because after trading this for so long and after journaling, I know the price tends to move there, and I can get a bit more money out of the trade. So hope you guys liked this video. If you did, leave a comment, and of course leave a like. If you have any questions, also leave a comment, and I'll speak to you in the next video. Thanks for watching.